Public Finance and 5 Fiscal Policy, Chapter 5.1. Introduction. Public finance is the study of the financial activities of governments and public authorities in an economy. It describes and analyses the expenditures of governments and the techniques used by governments to finance these expenditures. Finance is the fuel for the engine of governance. Fiscal policy is the strategy adopted by the government to raise revenue and spend it for the development of a country. The main instrument of fiscal policy is the budget. Deciding how much to spend, where to spend, and how to raise money for spending is the main purpose of fiscal policy. We have already discussed about monetary policy in the previous chapter. Although fiscal and monetary policy influence the economic performance of a country, fiscal policy is different from the monetary policy. While fiscal policy deals with taxation and government spending and is often administered by a government department, monetary policy deals with the money supply, interest rates, and is often administered by a country's central bank. 5.2. Budget. The term budget has been derived from a French word, budget, which means a leather bag or wallet. Budget is a document which contains estimates of the revenue and expenditure for a year. Article 112 of Indian Constitution refers to the budget as an annual financial statement that is a statement of receipt and expenditure of the government of India in a financial year. In other words, budget means a statement of the government's needs and resources. It is a legal document designed for optimal allocation of scarce resources, taking into account socioeconomic and political consideration. It ensures legislative control over the executive through debate and discussion on budgets, cut motions, enactment process, etc. This is in accordance to Article 114.3 of the Constitution, which states that no amount can be withdrawn from the consolidated fund without the enactment of such a law by Parliament. The budget is not merely a statement of receipts and expenditures. Along with it, 3 policy statements are mandated to be presented by the Fiscal Responsibility and Budget Management Act, 2003. FRBM. The medium-term fiscal policy statement sets a 3-year rolling target for specific fiscal indicators and examines whether revenue expenditure can be financed through revenue receipts on a sustainable basis and how productively capital receipts, including market borrowings, are being utilized. The fiscal policy strategy statement sets the priorities of the government in the fiscal area, examining current policies and justifying any deviation in important fiscal measures. The macroeconomic framework statement assesses the prospects of the economy with respect to the GDP growth rate, fiscal balance of the central government, and external balance. 5.3. Types of budgets. Budget is generally made for 1 year, as in the case of India. However, there can be a long-term budget as well. Long-term budget plans for expenditure and revenue over multiple years. India does not have a long-term budget, but it has a long-term fiscal policy as mandated by FRBM Act. Further, when a budget is prepared by the executive and responsibility for its execution lies with the executive, after approval of budget by the legislature, it is known as executive budget. This is the form of budget in India. Alternatively, when a budget is prepared by a committee of the legislature on the request of the executive, it is known as a legislative budget. India does not have this concept. Zero-based budget, ZBB, refers to planning and preparing the budget from scratch or zero base. In this method of budgeting, every expense is evaluated each time the budget is made. It is based on the concept that every expense should be justified for each new period. In India, ZBB was first introduced in the Department of Science and Technology in 1983. For example, let's say there is a poverty alleviation scheme like MNREGA, and every year 1,000 crores are allotted as per normal budgeting. But ZBB tells us that there should be no fixed amount to be allotted, and every year, before the budget, MNREGA should be evaluated for its past performance and the target of poverty reduction to be achieved the following year, and the outlay from MNREGA should be made accordingly. Another way of budgeting is traditional/incremental budgeting, which decides outlay on the basis of the previous year budget. Performance budget is a system of presentation of public expenditure in terms of functions, programs, activities, and projects that primarily reflect the input cost and outputs achieved. In simple terms, it is a budget which has outlays with performance targets that have been achieved for the amount of cost being put in. For example, in a performance budget of the Ministry of Health and Family Welfare, the government says that with an allocation of 1,000 crores for Janani Suraksha Yojana, JSY, preceding year, the MMR has reduced from 212 to 190. This means the money that was spent has shown a significant outcome, and based on this performance, money will be allotted for the following year. A system of performance budgeting by ministries was introduced in 1969, following the recommendations of the Administrative Reforms Commission. However, certain weaknesses were observed in the performance budget documents, such as 1. Lack of clear need-to-one relationship between the financial budget and the performance budget. 2. More focus on physical outputs that are more readily measurable than the outcomes that are the end objectives of state intervention. To overcome these weaknesses, an outcome budget was introduced. Outcome budget seeks to bring correlation between outlay, output, and outcome. Outlay is the amount that is provided for a given scheme or project in the budget. Output refers to the direct and measurable product of program activities, often expressed in physical terms or units. Outcome is the collective result or qualitative improvements brought about in the delivery of these services, often expressed in terms of improvements over earlier indicators and benchmarks. It aims to look at the performance of various ministries handling development programs. In simple terms, it sets measurable and monitorable targets for the allocation on every planned project under various ministries. For example, in an outcome budget to the Ministry of Health and Family Welfare, a government can allocate a total of 5 Indian rupees lakh crores on a condition that the ministry should bring down IMR to less than 25 and MMR to less than 110 before the end of financial year. From the financial year 2006 to 2007, every ministry presents a preliminary outcome budget to the Ministry of Finance. Ministry of Finance is the authority that compiles all such outcome budgets. Gender budgeting looks at the government budget from a gender perspective to assess how it addresses the needs of women in the areas like health, education, employment, etc. It is not a separate budgeting process. It seeks affirmative action to address specific needs of women. It looks at the budget in a way to mainstream the gender objective, to ensure that benefits of development reach women. It monitors both the expenditure and public service delivery based on women targets and achievements. There are gender budgeting cells, GBC, being set up in all ministries/departments to promote the task of gender budgeting. Gender budgeting was first introduced in Budget 2005 to 2006, and the budget is usually presented as 2 parts. 1. Part A deals with women-specific schemes, which deals with 100% allocation to women. E.g., Beti Bachao scheme. 2. Part B deals with pro-women schemes, where there is preferential allocation to women. Example, in the Stand Up India scheme there is a special target to promote women entrepreneurs. Planning, programming, and performance budget, PPBS, is a technique for optimizing allocation of funds in the budget through exercise of proper choice among programs which compete for limited resources. It involves 3 steps. 1. Planning, identification of goals and objectives. 2. Programming, prioritizing the goals. 3. Budgeting, allocation of funds. 5.4. Components of a budget. Budget constitutes 2 accounts, revenue account and capital account. Revenue account shows the current financial year receipts of the government and the expenditure that has to be met from these receipts. For the ease of understanding, these are one-way transactions. For example, government collecting tax is a one-way transaction which falls into revenue account. Similarly, government spending for salaries. Structure of government budget, budget receipts, revenue expenditure, capital receipts, capital expenditure, budget expenditure, figure 5.1, classifications within a budget. Capital account is an account of the assets as well as liabilities of the government which takes into consideration changes in capital. It can be seen as a two-way transaction. For example, when government borrows, it has to pay back in future. Similarly, when government spends on infrastructure, one-way money is spent, and on other way an asset is created. This account comprises foreign direct investments, portfolio investments, etc. It gives a summary of the net flow of both private and public investment into an economy. These two accounts are further classified into receipt and expenditure. Revenue receipts are those receipts which do not lead to a claim on the government in future. They are therefore termed non-redeemable, can't be claimed from the government. In simple terms, these receipts do not create any liability or any reduction in the assets of the government. They are divided into tax and non-tax revenues. Tax revenue is the income earned by tax efforts of government. It has been further divided into direct taxes revenue, such as income tax on personal income and corporation tax on firms, and indirect revenue like excise taxes, duties levied on goods produced within the country. Customs duties, taxes imposed on goods imported into and exported out of India, goods and services tax, etc. Non-tax revenue is the revenue other than taxation for the government. It mainly consists of interest receipts on account of loans by the central government, dividends and profits on investments made by the government, fees and penalties and other receipts for services rendered by the government. Capital receipts are all those receipts of the government which create liability or reduce financial assets. Liability is created when government receives money by way of loans. Sale of government assets, like sale of shares in public sector undertakings, PSUs, reduces the total amount of financial assets of the government. The main items of capital receipts are market borrowing, loans from the central bank, recovery of loans granted by the central government, and those receipts out of selling of government properties and disinvestments. The capital receipts can be further divided into debt capital receipts and non-debt capital receipts. Those receipts that create a repayment burden on the government are debt capital receipts. It includes borrowings of the government from RBI through sale of G-securities/T-bills, market borrowings, loans from other countries or international organizations, etc. Non-debt capital receipts are those receipts that do not create a future repayment burden on the government. It includes disinvestment proceeds of the government, sale of properties or stake in organizations, receipts from recovery of loans, etc. On the expenditure side, revenue expenditure are those expenditures which do not create any assets. These are the expenditures incurred for the routine, usual, and normal day-to-day running of the government. It includes interest payments, subsidies, wages to government employees, pensions, social services, and so on. Revenue account receipt, expenditure, tax, non-tax. Direct income tax, corporate tax, property tax, indirect GST, central excise tax, custom duty. Profits and dividends the government gets from its public sector undertakings. Interest received, grants which the governments receive from state governments or foreign countries. Interest payment by the government on the internal and external loans, salaries, pension and provident fund, subsidies, defense expenditure. Grants given by the government to Indian states and foreign countries. Capital expenditures are those expenditures that create some asset or reduce the liability for the government. These include loans to public enterprises, loans to states, union territories, and foreign governments, acquisition of valuables, and spending on infrastructure, etc. Capital account receipt expenditure. Debt borrowings by the government, internal as well as external, non-debt disinvestment loan recovery loan repayments by the government, capital expenditures on defense by the government capital asset. Figure 5.2, central revenue and expenditure 5.5, deficits in public assets, not raising salaries, not promoting credit uptakes, or even lacks the ability to finance. Undertake developmental work. However, when government revenues exceed deficits and budgets are more common, the expenditures, the budget is said to where government expenditure exceeds. Be in surplus. A budget surplus is not revenues collected. There can be many, always a good sign. Budget surplus points forms of deficit depending upon the to a possibility that the government is not spending enough in creation of new components taken into consideration. Budget deficit is the difference between the total expenditure and total receipts of the government. Usually, the budget deficit is zero as the government always matches the shortfall in revenue with borrowings or other measures. Budget deficit equals total expenditure, TE, total receipts, TR. Revenue deficits are defined as the excess of revenue expenditure over revenue receipts. When the government incurs a revenue deficit, it implies that the government is dissaving and is using up the savings of the other sectors of the economy or borrowing to finance a part of its day-to-day consumption expenditure. Since a major part of revenue expenditure is committed expenditure, interest repayment, pension, salaries, etc., it cannot be reduced. In a bid to reduce revenue deficit, the government often reduces productive capital expenditure or welfare expenditure. This is the most undesirable part of the budgetary deficit from the perspective of economic development. Revenue deficits equals revenue expenditure, revenue receipts. Fiscal deficit is the difference between the government's total expenditure and its total receipts excluding borrowing. Fiscal deficit equals total expenditure, total receipts, except borrowings. The fiscal deficit is financed through borrowing and hence, it indicates the total borrowing requirements of the government from all sources. Borrowing creates a problem of not only a payment of interest but also of b. repayment of loans. Ultimately, the government may be compelled to borrow to finance even interest payment leading to emergence of a vicious circle and debt trap. The other option to finance fiscal deficit is for the government to borrow from the RBI, and RBI does this by printing more currency notes, monetization of deficit asterisk. This results in circulation of more money that may cause inflationary pressure in the economy. Fiscal deficit retards future growth due to interest payment pressure. Government can also borrow from foreign countries. This increases dependence on foreign countries, which may lead to interference of other countries in domestic economic and political policies. Asterisk, we'll discuss this in more detail in next topic. Revenue deficit in 2024 to 25 is targeted at 1.8% of GDP. This is lower than the actual revenue deficit of 2.6% of GDP in 2023. 24. Fiscal deficit in 2024 to 25 is targeted at 4.9% of GDP, which is lower than the actual fiscal deficit of 5.6% of GDP in 2023 to 24. Primary deficit is the difference between the current year's fiscal deficit and the interest paid on the borrowings of the previous years. It is measured by subtracting the interest payments from fiscal deficit. In simple words, it tells about deficit of current year alone. The goal of primary deficit is to measure present fiscal imbalances. Any 2 years, for example, might be compared, and so many things can be found out clearly, such as which year the government depended more on loans, the reasons behind higher or lower fiscal deficits, whether the fiscal deficits have gone down due to falling interest liabilities or some other factors, etc. Primary deficit equals fiscal deficit, interest payments on previous borrowings, figure 5.3, trends in deficit. Effective revenue deficit adjusts for the capital expenditure undertaken by states from the grants they receive from the center. Grants to the states are accounted for the revenue expenditure, yet certain grants are used in creation of capital assets by states. These grants that are given to the states and still being used for the creation of capital assets are deducted from revenue deficit to get effective revenue deficit. The concept of effective revenue deficit was introduced in the Union Budget 2012-13. Effective revenue deficit equals revenue deficit. Grants for the creation of capital assets 5.6. Deficit financing. Deficit financing is a practice adopted for financing the excess expenditure, deficit, with outside resources. The expenditure gap is financed by either borrowing from RBI, monetized deficit, or through borrowing from the market. Governments have mostly relied on borrowing from the market, giving rise to government debt. The concepts of deficits and debt are closely related. One of the main criticisms of deficits is that they are inflationary. This is because when government increases spending, higher expenditure, or cuts taxes, leading to reduced revenue receipts. Aggregate demand increases as economic agents, people/firms, now have more money with them. Producers may not be able to produce higher quantities that are being demanded at the ongoing prices. Prices will, therefore, have to rise. There is also a decrease in investment due to a reduction in the amount of savings available to the private sector. This is because if the government decides to borrow from private citizens by issuing bonds to finance its deficits, these bonds will compete with corporate bonds and other financial instruments for the available supply of funds. If some private savers decide to buy bonds, the funds remaining to be invested in private hands will be smaller. Thus, some private borrowers will get crowded out of the financial markets as the government claims an increasing share of the economy's total savings. Instead of borrowing from a domestic source, government can also borrow from external sources. External borrowing brings in foreign currency. It is preferred over the internal borrowings due to elimination of crowding out effect. If the government itself goes on borrowing from the banks of the country, other investors may be left out. An increased borrowing program means that the public debt will go up. A large portion of revenue collected will be used for paying the interest from ways and means advances. In an economy, all receipts are received with a lag while expenditures are incurred immediately. For example, direct tax for the period of April to next quarter will be collected at the end of the quarter. However, during this period, government fasto pay salaries, pension, subsidy sec, tow dresses mismatch, RBA provides a temporary overdraft, a facility called ways and means advance. It is for a time period of 90 days, and the amount of overdraft is 20,000 Indian rupees crores during April to September and 600 Indian rupees crores during October to March. These loans leaving little amount for productive use. As discussed earlier, another way for deficit financing is through monetization of deficit. It involves monetization of fiscal deficits with money, instead of debt, borrowing, to be repaid at some future dates. So, it is a form of non-debt financing. As a result, under monetization, there is no increase in net public debt. Monetization of deficit can be done under two ways: direct monetization and indirect monetization. Under direct monetization, RBI prints new currency and purchases government bonds directly from the government using this currency. In indirect monetization, deficits are monetized as the government issues bonds in the primary market and RBI purchases an equivalent amount of government bonds from the secondary market in the form of open market operations, OMOs. Direct monetization of deficit was in practice in India till 1997, whereby the central bank automatically monetized government deficit through the issuance of ad hoc treasury bills. Treasury bills are money market instruments, are short-term debt instruments issued by the government of India and are presently issued in 3 tenors, 91, 182, and 364 days. In 1994 and 1997, 2 agreements were signed between the government and RBI to completely phase out funding through ad hoc treasury bills. Later on, with the enactment of Fiscal Responsibility and Budget Management, FRBM Act 2003, RBI was completely barred from subscribing to the primary issuances of the government. The FRBM Act as amended in 2017 contained an escape clause which permits monetization of the deficit under special circumstances. 5.7. Public debt. The central government debt includes all liabilities of the central government contracted against the Consolidated Fund of India, defined as public debt, and liabilities in the public account, called other liabilities. Non-marketable debt. Marketable debt comprises of government-dated securities and treasury bills. Issued bills public debt is further classified into internal and external debt. Internal debt consists of marketable debt and through auctions. Non-marketable debt comprises of intermediate treasury, 14-day ITBs, issued to state governments /UT of Puducherry and select central banks, special securities issued against small savings. Special securities issued to public sector banks /EXIM Bank, securities issued to international financial institutions, and Figure 5.4, General Government Debt as percentage of GDP. Figure 5.4, General Government Debt as percentage of GDP. Compensation and other bonds. Other liabilities include liabilities on account of state-provident funds, reserve funds and deposits, other accounts, etc. Public debt includes the total liabilities of the Union government that have to be paid from the Consolidated Fund of India. Sometimes, the term is also used to refer to the overall liabilities of the central and state governments. However, the Union government clearly distinguishes its debt liabilities from those of the states. It calls overall liabilities of both the Union government and states as General Government Debt, GGD, or Consolidated General Government Debt. There are limits to which revenues from the taxes can be raised to meet ever-increasing expenditure. Therefore, government resorts to public borrowing. Public debt includes internal debt and external debt. Internal debt indicates the amount of loan raised by the central and state government from within the country. External debt is that amount which central government borrows from international financing agencies for financing various developmental projects. These agencies. Debt position of the government of India. The outstanding internal and external debt and other liabilities of the government of India at the end of 2024 to 2025 is estimated to 181.68 for 56.91 crore. As against 168.72, 554.16 crore at the end of 2023 to 2024 RE. Broad details are as follows: as on March 31st, 2023, as on March 31st, 2024, as on March 31st, 2025 internal debt and other liabilities. 154.1 lakh crore, 163.3 lakh crore, 175.9 lakh crore, external debt 7.49 lakh crore, 5.37 lakh crore, 5.74 lakh crore, total 155.6 lakh crore, 168.7 lakh crore, 181.16 lakh crore. Include World Bank, International Monetary Fund, etc. It has to be repaid in the currency in which it was borrowed. Over the years, the Union government has followed a considered strategy to reduce its dependence on foreign loans in its overall loan. Internal debt constitutes more than 93% of the overall public debt. Debt versus deficit. While deficit measures the expenditure-revenue gap in a particular year, debt tells how much the government has borrowed over the years to bridge the expenditure-revenue gap. In simple terms, all deficits over the years add to become the total debt. 5.7.1. Debt to GDP ratio. Debt to GDP ratio is the ratio between a country's debt and its gross domestic product. It is an indicator on how capable a country is in paying its debts. It gives a clear picture how much a debt a country owes and how much it produces to pay off its debts. The higher the debt to GDP ratio, the less likely the country will pay back its debt and the higher its risk of default. A low debt to GDP ratio is a measure of a healthy economy that produces and sells goods and services without accumulating future debts. Central government's debt remained stable at around 45% of the gross domestic product, GDP, although the liability, in monetary terms, has increased substantially over the last decade. However, debt to GDP ratio rose sharply in 2020-21 on account of two reasons. A. Higher borrowing due to COVID-19 pandemic. B. Contraction in GDP. Currently, as of March 2024, central government's debt stands at 58.9% of GDP. 5.8. Fiscal policy. Fiscal policy is the policy of the government related to the level of government purchases, the level of transfers, and the tax structure. It aims to use its three major instruments, taxing, spending, and borrowing, for the development of the economy. The government of India frames its fiscal policy keeping in mind certain objectives that include 1. To mobilize adequate resources for financing various programs and projects adopted for economic development. 2. To achieve an optimum utilization of resources, to raise the rate of savings and investment for increasing the rate of capital formation. 3. To promote necessary development in the private sector through fiscal incentive. 4. To control the inflationary pressures in the economy in order to attain economic stability. 5. To eradicate poverty and unemployment, to reduce regional disparities, to reduce inequality in the distribution of income and wealth. Fiscal stance refers to posture/attitude of the government reflected through its fiscal policy in terms of taxation and spending. Fiscal stance can be expansionary, stimulatory, neutral, or consolidatory. Fiscal neutrality is the situation when the net effect of taxation and public spending is neutral, neither stimulating nor dampening demand. The term can be used to describe the overall stance of fiscal policy. A balanced budget is neutral, as total tax revenue equals total public spending. Fiscal stimulus consists of attempts by governments or government agencies to financially stimulate an economy. An economic stimulus is the use of monetary or fiscal policy changes to kickstart growth during a recession. Governments can accomplish this by using tactics such as lowering interest rates, increasing government spending, and quantitative easing, to name a few. Debt. Fiscal consolidation refers to the actions and policies adopted by the governments, national and state levels, to reduce their deficits and decrease the accumulation of the path adopted for fiscal consolidation in India is enumerated in the Fiscal Responsibility and Budget Management (FRBM) Act, 2003. 5.8.1. Evolution of fiscal policy in India. Deficit. Through the fiscal policy, the government of a country controls the flow of tax revenues and public expenditure to navigate the economy. If the government receives more revenue than it spends, it runs a surplus, while if it spends more than the tax and non-tax receipts, it runs a. Fiscal policy of the government of India has impacted the economy considerably. The objective of fiscal policy during the 1950s and 1960s was mainly to increase the growth rate of the economy through increasing public investment and overall economic planning. Taxation was used as an instrument for reducing private consumption and for transferring resources to the government to enable it to undertake large-scale public investment in an effort to spur economic growth. Fiscal policy during the 1970s consciously focused on achieving greater equity and social justice, and both taxation and expenditure policies were employed towards this end. Accordingly, income tax rates were raised to very high levels. Government's expenditure also widened to cater to the rising subsidies in addition to developmental expenditure. During the 1980s, fiscal deterioration took place, and eventually it became unsustainable, though the growth rate did rise significantly with enhancement in public investment in infrastructure. The 1980s witnessed a steady increase in market borrowings along with an increase in reserve bank support to such borrowing. India's balance of payments (BOP) crisis of 1991 led to economic liberalization. The reform of the tax system commenced, and the fiscal deficit was brought under control. When the deficit and debt situation again threatened to go out of control in the early 2000s, Fiscal Responsibility and Budget Management (FRBM) Act 2003 was instituted. Problems with high fiscal deficit. As discussed before, high fiscal deficit creates inflationary pressure and crowds out private investment. High fiscal deficit, financed through borrowings, imply that the future governments/generations should pay for these interest burdens. It is like taxation of the younger generation. Too much borrowing might decrease the credit ratings of the government bonds due to risk of default. This decrease in ratings makes it more costly for the government to raise new loans. Per the credit rating, the higher the risk and costlier the credit. This puts a burden on interest payments and it may lead to debt trap. However, a very low level of fiscal deficit may not be always desirable. There may be situations, such as the need for increased government spending for post-pandemic recovery, that requires the government to incur higher fiscal deficit. 5.8.2 Fiscal Responsibility and Budget Management (FRBM) Act 2003. The fiscal consolidation that followed in 1991 failed to give the desired results as there was no statutory obligation to do so. This is why the Fiscal Responsibility and Budget Management Act (FRBMA) was enacted on August 26, 2003 to provide the support of a strong institutional/statutory mechanism. It aims to make the central government responsible for ensuring intergenerational equity in fiscal management and long-term macroeconomic stability. According to FRBM, the government should eliminate revenue deficit and reduce fiscal deficit to 3% medium term of the GDP. FRBM Act provides a legal institutional framework for fiscal consolidation. It is now mandatory for the central government to take measures to reduce fiscal deficit, to eliminate revenue deficit, and to generate revenue surplus in the subsequent years. The act binds not only the present government, but also the future government to adhere to the path of fiscal consolidation. The government can move away from the path of fiscal consolidation only in case of natural calamity, national security, and other exceptional grounds which central government may specify, escape clause. The act prohibits borrowing by the government from RBI. Thus, it makes the monetary policy independent of fiscal policy. Also, the act bans the purchase of primary issues of the central government securities by the RBI after 2006, preventing monetization of government deficit. Further, the act requires the government to lay before the Parliament 3 policy statements in each financial year, namely medium-term fiscal policy statement, fiscal policy strategy statement, and macroeconomic framework policy statement. To impart fiscal discipline at the state level, the 12th Finance Commission gave incentives to states through conditional debt restructuring and interest rate relief for introducing fiscal responsibility legislations, FRLs. All the states have implemented their own FRLs. Figure 5.5, gross fiscal deficit, center and states combined, percent of GDP. 5, 8, 2 to 1, FRBM Review Committee and K. Singh Committee. The government constituted a committee to review FRBM in 2016 under the chairmanship of N. K. Singh. Some of the recommendations of this committee are as follows. 1. Debt to GDP ratio of 60% should be targeted with a 40% limit for the center and 20% limit for the states, and it proposed yearly targets to progressively reduce the fiscal and revenue deficits till 2023. Debt Rule 2. It suggested setting up an autonomous fiscal council, which will be tasked with monitoring the government's fiscal announcements for any given year. 3. The committee noted that under the FRBM Act, the government can deviate from the targets in case of a national calamity, national security, or other exceptional circumstances notified by it. But the deviation should not be more than 0.5% of GDP in a year. Escape clause. 4. The committee recommended that the 15th Finance Commission should be asked to recommend the debt trajectory for individual states. This should be based on their track record of fiscal prudence and health. 5. Borrowings from the RBI. According to the suggestion of the committee, government must not borrow from the Reserve Bank of India, RBI, except when A. The Union government has to meet a temporary shortfall in receipts. B. RBI subscribes to government securities to finance any deviations from the specified targets. C. RBI purchases government securities from the secondary market. The government has accepted in Union Budget 2018-19 Debt Rule and Escape Clause. 5.8.3. Fiscal consolidation in India. The average combined fiscal deficits of the center and states after 1975 had been above 10% of the GDP till 2000 to 2001. More than half of it had been due to huge revenue deficits. It was at the behest of the IMF that India started the politically and socially painful process of fiscal reforms, a step towards fiscal consolidation. India began the process of rationalization of the tax structure in the 1990s. The Tax Reforms Committee, TRC, was constituted, and it recommended 2. 1992. Major reforms on direct taxes. One was the simplification and rationalization of the direct tax structure, Shalaya Committee. The other was to introduce a service tax to widen the tax base. Since the 1990s, a number of steps has been taken by the government at the center in the direction of fiscal consolidation, and there have been continuous attempts to do the same at the level of states. Various steps were initiated by the government for cutting down its revenue expenditure. For example, cutting down the burden of salaries, pensions, and the PFs, cutting down the subsidies, etc. The government increased its revenue receipt by reforming its tax structure. Examples of such tax reforms include simplification and rationalization of income tax and corporate tax, introduction of SENBIT, VAT, service tax, GST, etc. The Ways and Means Advances (WMA) scheme was announced in 1997, under which the government commits to the RBI about the amount of money it will give as part 2003 of its market borrowing program to bring transparency in public expenditure and to put political responsibility on the government. The Fiscal Responsibility and Budget Management (FRBM) Act, which puts legal obligation on the government to commit to a roadmap of fiscal consolidation. Double Taxation Avoidance Agreement (DTA) has been renegotiated, and tax treaties have been signed with various countries to minimize tax evasion and avoidance through tax havens. A mechanism to include state governments under the umbrella of fiscal responsibility was advised by the 12th Finance Commission. It allows the state governments to borrow money from the market for their developmental needs without permission from central government, provided they pass their Fiscal Responsibility Acts (FRAs). By March 2016, all states and UTs had implemented their FRAs. Related concepts. Fiscal drag. Fiscal drag means slowdown of economic growth as a result of people moving into higher tax brackets and paying larger a proportion of their income as tax that ultimately reduces the demand in an economy. For example, Mr. A, who was earning 2.4 lakhs, need not pay tax. But due to inflation, his income also grew, and it became 2.8 lakhs. Now, since he has moved to a tax bracket above 2.5 lakhs, he has to pay tax. This increases the tax revenue for the government without actually increasing the tax rates. But this also increases the tax burden on people, which reduces consumer spending. This leads to fall in aggregate demand and can lead to deflation in the economy. Golden Rule. It is a rule which suggests that over an economic cycle, the government should borrow only to invest and not to finance the current expenditure. Twin deficit problem. Recently, Ministry of Finance in its monthly economic review cautioned their emergency off the twin deficit problem in the economy, with higher commodity prices and rising subsidy burden. Twin deficit refers to a nation's current account deficit and a simultaneous fiscal deficit.